All right. So tell me, like, give me your whole story. What, when you packed up the wagon and you moved out of Chester, where'd you go? Where'd you go?
Yeah, for sure. So I'll kind of give the holistic backstory. I'll try and make it quick, hit the spark notes, but, parents ran a business. My dad's an immigrant. He came from Sweden. And him and my mom started a wood chipping business. So nothing to do with real estate, but, was exposed to entrepreneurship pretty early. Like I said, I grew up in Southern New Hampshire in Chester. I can't imagine anyone that's not from New Hampshire knows where Chester is, but it's about an hour north of Boston to give a geographical reference. So, grew up in Chester, was always doing anything to make a buck outside of getting a job. So I was always buying and selling stuff online and, flipping Xboxes and buying and selling baseball cards. And, eventually went to college out at UNH. So I went to school on the seacoast of New Hampshire.
Yeah.
And at that time I was buying and selling cars, and that was, kind of like my side business and my income source. And I think it was freshman, sophomore year of college, I was like, this is getting a little stale, and I'd like to do something that I might be able to do after I graduate, in terms of like starting a business. So I think I literally Googled one day, like, what do wealthy people buy and sell or something like that, and came across flipping real estate, and, started listening to podcasts and learning about real estate. And that was my first interest in real estate, was going out and flipping houses. So as I was learning about that, I stumbled upon rental real estate and multifamily real estate, the concept that you can buy a property, your tenants pay your mortgage, and then, you got some left over at the end of the month. And I said, hey, that sounds like a bit of a better deal. So I started trying to figure out how I could buy small multifamily properties or some kind of rental properties. In college, that's hard when you have no income, no real tax returns, and, not a lot of money in the bank. So, I started networking with some private lenders, started going to a bunch of meetup events, started looking for off-market deals, discounted deals, and eventually started putting together, some small multifamily deals towards the tail end of college, 2, 3, 4 unit properties, nothing crazy.
Okay, but I was raising. How did you do that? Because I see that in your bio, and my first thought was, man, I was of the age that back when I was your age in college, they would allow you to take $10 out of an ATM, and that would last me all weekend long. And here you are. I never would have thought to even go and start buying property while I was still in college. How'd you do it? Why? Where was the person who told you you're not supposed to do that? And so that you didn't have the opportunity not to listen to them.
Yeah, I think I was pretty fortunate in that I didn't really have like the naysayer. I didn't really have one person going, oh, you can't do that. I probably did with some people that were like, maybe like my peers that couldn't conceptualize it. Right. But I think I was like, oh, whatever, I'm going to figure it out. And at the time, I did have a couple of bucks from buying and selling cars, like $20K, something like that, which at the time was, meaningful, but enough to, I was like, maybe, if I get a, high LTV loan, if somebody finances the majority of a purchase price, I can put that down and put the pieces together. The real challenge for me was being lendable, because I didn't have a W-2 income, and I had, there was nothing to even show on tax returns. I didn't really have credit either, since I'd yet to start building credit. So what I had to solve for was finding someone to loan me the money. And I would say that it worked out pretty well for me, and that I had an internship at that time with an angel investment group in Manchester, New Hampshire. And I met a guy at the time that was going to a couple of these meetings, and my role was like, I was, more or less taking notes and helping to schedule the meetings and bringing coffee and, pure admin type work.
Yeah.
But there's a gentleman that went to a couple of meetings there who basically at the time he was, investing in startups. He ran his business, and then he did some private money lending, some hard money lending to real estate investors. And I just got to chat with him one day, telling him about what I wanted to do. And he was like, yeah, if you find a really good deal, we can figure it out. And if it's below market value, if there's equity in terms of you're buying it at a price that's below the market value and you're actually closing with some margin there, happy to entertain extending a loan. So I found a good deal on Craigslist at the time. I would scour Craigslist for sale by owners.
Okay, I have to stop you right there for a second. I was just going to tell you that your homework when this is done is to go back into my podcast and listen to the podcast with Michael LaFavor, who is a Nashua boy, and he's about your age. and he's converting the Henry Hanger Mill building into apartments.
Okay.
And listen, that's an iconic building here in Nashua, and I've driven by it millions of times. And I said, Mike, how did you find that deal? He goes, you're never going to believe it. As a driver, he goes, Craigslist.
Yeah.
I couldn't believe it. He found a mill building on Craigslist.
You find some funny stuff on there.
Yeah.
I made a lot of offers for a lot of weird pieces of real estate, single family with like a barn that somebody turned into store. You get a lot of weird stuff on there. And, and oftentimes you just get people that are just allergic to working with a real estate broker. And they're like, let me put it on Zillow, let me put it on Craigslist, or let me put it on some site to try and find a buyer. And that's what happened here is I found a seller who had a 3-unit property in Chester, believe it or not, one of like the 5 properties in Chester that are multifamily properties.
So right now you're the largest landowner in Chester, practically.
Yeah, but by unit count standpoint.
Exactly.
So anyways, I went and found that deal, put it together with this private lender. He financed 90% of it. I brought the rest. I think I took an advance on a credit card to like help pay the closing. I mean, all the stuff that you're not supposed to do, right? And all the risky stuff, but didn't require that much work, and it was income producing when I bought it. So I could pay my high interest private money loan, which I think was 11%. And I was like, all right, I'll go and, refinance out of it when that time comes. So that all worked out and that went well. And to fast forward a little bit, the snowball started to grow at that point. Did a couple deals that first year, a few more the second year, a few more that, the third year, and started selling some of the earlier ones that I bought to fund new acquisitions. And over a 4 or 5 year period of time, built a nice portfolio just organically through cash flowing and buying at the right price and really repurposing cash effectively and efficiently. Kind of replaced my income, quit my job, and started to grow a real business around buying real estate. And really in the last 3 or so years, since just before COVID, so I mean, we're coming up on about 3 years, started getting serious about raising money and buying larger assets. And we started looking in areas outside of New Hampshire as well. So first 5 years were all New Hampshire. And then after that, started looking in Central Florida. We've done a few deals down there. We've done a couple deals out in the Midwest. And New Hampshire is still where we do the vast majority of our deals. But just in general, just started to grow and started raising capital from folks who wanted to invest passively, started syndicating deals, started a property management company in New Hampshire to manage our properties in-house. And we do some third party now. But it's very much been organic growth over the last number of years and, just solving a problem at a time. Just, ran out of capital to buy our own stuff. So we started raising some money. Didn't really like our third party management company. So started a management company, ran out of opportunity in New Hampshire because there's just not that much real estate there to buy. So we started looking out of state. And that's what we have today is, our business now, Aligned Real Estate Partners, is a true syndication company now where raise money from investors and we buy value add multifamily real estate with that capital. And looking to keep it rolling, keep the train going.
Now, who's we?
I just say we to this. So I'm the only owner in the business, only partner,
okay.
But I say we, I have staff now. I got a director of operations, acquisitions manager. It's a team effort, right? I think is what I'm talking about.
Good for you. Now, let's get back to your college days. When you first started to do the acquisition, where were you finding your deals?
So everything was direct to seller, literally everything. And that was a really clear focus that I had at the time. Was the only way that I can keep buying real estate was if I'm buying it at 75% below market value, or 75% of market value, 25% below. So that once I create, do my value add, I increase the NOI and I create the value at the property level, I can go out and refinance my capital out. Like that was the whole game to me, was I got to get all my money out so I can go throw it in the next deal. So at the time I did a lot of direct to seller marketing, whether it was, sending mailers. I did a lot of prospecting, just emailing owners, going out there, buying a list, getting the owner's name, phone number, email address, sending them an email, calling them up, sending them a mailer, just started building relationships over time. And, it was kind of just sheer volume of effort that really grew the portfolio initially. And then over time started to get a little bit more wise about how I actually structured that side of the business. So at the time I had a young guy at UNH who was a freshman. His name's Isaiah. Maybe Isaiah will listen to this, but
he's one of my best audience members. Isaiah, yeah.
I was going to say, maybe, who knows? I wouldn't be surprised.
Exactly.
I want to tell him to listen because we got a New Hampshire host if he's not already, because he's a New Hampshire guy. But he was like, 19, freshman at UNH, and he wanted to, he reached out to me because we had a professor that we both knew, and she kind of connected us. And I said, hey man, here's my playbook. Go out there and implement it. If you find deals, they'll give you a percent, give you a bonus. So he started basically finding deals on our behalf, and now he's full time in real estate, and we actually partner on some deals together now.
Where's he located?
He's out in Rye. He lives out in Rye at the moment, but he just graduated. So he's on a better trajectory than even I am. He's way ahead. But it was just a whole, I basically downloaded my playbook on him, and then I started to outsource the acquisitions, which is really when the business started to grow, because I took that off my plate. So basically it was cold calling, cold emailing, and direct mail. And, we had a process where we'd hit every person on our list with one of those 3 tactics each month. And then you let time do its thing, let follow-up do its thing. And eventually folks are going to raise their hand and say, now I'm interested in selling. And you've been in my ear for the last 6 to 9 months. How'd you like to make an offer? And we converted a good percentage of those.
As I tell my students, direct mail works every time it's been tried.
Yeah, you just have to be patient. I think that's the biggest constant, is people don't have the patience, and they don't understand marketing 101, which is you got to touch a prospect 7 times in order to get a deal. And I think that's whether you're, selling flooring or trying to buy real estate or selling software, whatever it is, right? That's kind of the law of averages in the world of sales and marketing. And it's just really hard to stay in the game long enough to get out to that 7th contact, that 7th round of mail, that 7th round of cold calling. And I think if you have that patience, then you see those ridiculous results, and you're like, I can't believe I didn't start doing this sooner. I can't believe I didn't do more of it. Because the ROI on going direct to seller, especially in multifamily real estate, where the numbers are bigger, transactions are larger, and you increase the likelihood that you do multiple deals with the same seller.
Right.
Which is really how we started growing our portfolio. We bought that first property from, Jim, the seller of the 6 unit. And then when he wanted to sell his 8 unit next year, we were the first one he called, because it was very seamless in terms of a transaction the first time we worked with him. And that's where you start to really hit that snowball.
We got a phone call today. We're investors in an 88 unit hotel property that we're converting to apartments. And we just got a phone call this morning that the owner that we bought it from has a 135 unit hotel that he wants us to buy from him. And so he didn't even pick up the phone to call anybody else. He called us directly. So, and the first deal was a sweetheart deal. We can't wait to see what the second one is going to look like. And it's all because we're in the game. We did the prospecting. It's
exactly. And I think it also speaks to, like, if you're a really easy buyer to work with, like I was really focused on being a good buyer, in terms of, like, I didn't try to retrade after inspections. I wanted to be, really considerate and meet all the contracts and the timeline, and just be a pleasure to work with, so that, you put yourself in a position to get that next call. Because I remember we would buy properties from sellers who, they had started selling off their portfolio. They were trying to retire, get out of the business, and they had worked with different buyers before, but they were turned off because they went through the inspection process and a water heater was broken, and the buyer's trying to blow up the deal over a $2,500 water heater, and just had a bad taste in their mouth. Yeah. So if you take the opposite approach, you just sign yourself up to be on the front lines when a lot of those sellers go back, similar to what you're describing.
Hey, what's the biggest mistake you've made so far?
I did a flip a few years. I mean, this was early in the business, back when I was like, oh, I should still flip houses to make some money to go pour into multifamily. And I got absolutely hammered on a deal. Basically took me to zero, and I kind of had to restart. This was like 4 or 5 deals in. Yeah. Basically I had to sell a bunch of real estate to pay to get out of that deal. Yeah. And I think if I would have boiled down the mistakes on that one, because when I look back, that's the one that I think I learned the most on, was I'll narrow down to 2, because I could probably list like 20, but the 2 big ones were, I worked with the wrong people. This was out in Dover, New Hampshire. It was a duplex. I bought it at a foreclosure auction. And I think these lessons are applicable regardless of your strategy, whatever you're buying, through any asset class. And I hired the contractor I hired to do the work was the same contractor that I hired to do all of my apartment turns. And this was a bit of a higher end finish than what we were doing in the apartments that we owned, which were in a, more C-class areas. So different scope of work, different standard of finish that we needed to achieve. and just wasn't the right contractor for the job. And a lot of the work was done in a subpar fashion. We had to do a lot of it over again. And just the timeline wasn't there. It just wasn't the right fit. It wasn't the right individual to execute that project. And it was just complacency on my part saying, oh, he's done a good job on this other stuff. He should be able to do a good job here. And it just wasn't the right person to work with.
Yeah.
And the other piece of it was, I just bit off more than I could chew. And I think oftentimes this happens, and we've come close to this happening to us in the multifamily game too, where we just get into a project that's much more intensive than what we are used to doing, or that what we have done in the past. And with that deal, it was, we paid, I think it was $240 for the building, but the renos were about $120 on it. So it was and that was a lot bigger than anything I had personally managed at that time. It was just more moving parts, more vendors, bigger construction scope. And what I should have done in hindsight was bring in a partner to that deal to help me with it, who had done those types of flips, who was familiar with doing those types of renovations, that had walked that road, been down that path before me, so that I didn't have to learn it on my own, while I had a hard money loan on the property, while it's bleeding cash, et cetera. And, if we're to extrapolate that into the multifamily game, if you've only done, light value add types of deals in good neighborhoods, you're probably going to learn deal with some expensive lessons on the heavy value add C-class property, where you got to turn over the tenant base and you just have more construction and less income coming in throughout that process. And that was basically what I was dealing with, just on a smaller scale. But at the time, the lessons felt as significant. So, now if we're getting into a deal that is either just a larger scope than what we've done in the past, or it's slightly outside of the rinse and repeat types of deals that we have done, I look to bring in someone that has already done that, so that I can, just look at what they do, and then I can actually take care of that deal in the future if I find it. But I think, if I boil it down, those were the two biggest learning lessons on that one.
Okay, so is that why you made the switch from New Hampshire to other places around the country? And when you did make that switch, that's a totally new thing as well. Trying to manage a property 1,000 miles away, that's another learning experience you had to go through.
It was, yeah. So that was the deal that got me out of trying to flip real estate hard stop. I was like, that's not my game. Like, I don't have the personality type to be on site managing the contractor face to face on a daily, that's what you have to do when you're flipping houses. You have to be physically present, like, multiple times a week in order to keep that job. Or, you have to have a partner, that is, whatever the structure is, some level of ownership needs to be there. So
what you're saying right now is absolutely true. And I learned it the hard way when it was a property 1,000 miles away that I was trying to do a renovation on. So
and I could speak to that too.
Yeah, go ahead. Tell me about that story.
So when we got into Central Florida, I was looking in Lakeland, Florida, which for those who aren't familiar, a market that sits right in between Tampa and Orlando, about 35, 40 minutes from both of those major cities.
Yeah.
And we started looking there because it was more tertiary. In terms of, there was just less national competition. So, it was very similar to the market that we buy in New Hampshire, which is Manchester, New Hampshire.
Yeah.
And which obviously you're familiar with. But
very good market. Very good market.
Yeah. And this was early 2020. We started looking for deals down there. And it was still competitive, but less competitive than it is now. But at the time, it was less competitive than Tampa, Orlando. And you're right, it was a big learning curve for me, or just in terms of becoming comfortable with doing a deal out of state and understanding that there's just you have to put different things in place, get different people involved in the deal in order to protect yourself there. So first thing we did was start networking with folks in Tampa, specifically in Tampa because it's close to Orlando, and because I was also looking for deals in Tampa at the time, or close to Lakeland, I should say. We were looking for deals in Tampa, but we couldn't find anything. So we just naturally had a network of folks in Tampa. We met a couple of guys who were, similar in age, similar in just objectives from an investment standpoint, similar values, checked all those boxes. And they ended up finding a deal in Lakeland because they were also looking in Lakeland, and they brought us in to raise the money and to, help qualify the loan. And in that fashion, we protected our downside because we had two guys who were down there that were local, that were partners in the deal. So we had somebody that could get on site whenever that was needed. And we also had an unbelievable management company, which, I think everyone understands that you need a good management company, but it truly is so critical to get that right when you're investing out of state. And, they manage thousands of units throughout Florida. We loved our regional representative there, and we basically set a lot of expectations up front, or I should say I did, where I said, when we have a vacancy, when we're turning units, when you're walking the property, I always want videos. Like, I'd love for you to get on site and FaceTime me once every couple of weeks, once every few weeks, and just walk the outside of the property, show me what's going on. And you know, some PMs might not agree to that level of service to a client, but they were willing to provide it. And you know, I just asked for it, right? I said, hey, I'd love a call every, you know, biweekly call where we discuss the property. You're always sending pictures, videos of renos, et cetera. When you get on site, I'd love to FaceTime you, right? And this is how often I want you to do that. So that made me feel a lot more comfortable. And then obviously having two guys in the deal that were local was huge. And we did a couple more deals down there with those two gentlemen. But the most recent deal, we did a 48 unit deal in Bartow, Florida, which is about 10 minutes south of Lakeland. They're not involved in that deal. We're the only, you know, sponsor on that deal. And but I felt comfortable with it because I had this relationship with the PM company that became so strong that I didn't really feel the need to have a local partner. And I'm also willing to get down there whenever, right? It's a quick flight. I go down on a pretty regular basis down to Florida, drive the property, meet the brokers, you know, do some business development. So I'm being long-winded, and I guess the short answer to your question is great team, great PM, you know, partners that are local, and just a willingness to get down there yourself if you need to. And
Because you're from New Hampshire?
Yeah. I mean, I'm not opposed. I mean, I always like to really stack all the visits in the wintertime.
No kidding. Yeah.
Which
Like
is
right about now. Right about
yeah, exactly.
You know, it's like we have a big nor'easter coming in for Axel and I are gonna get hit with it tomorrow. Let me ask you something. You talk about the physical management, you being down there, FaceTiming and seeing it. Tell me how you run the books, how you manage the money, how you manage the, you know, your budget every single week or month, or how do you do that?
No, that's a good question. Yeah. And, you know, first thing, the low hanging fruit, but I'll mention it, is you need unbelievable reporting from your PMs.
Yeah.
Different PMs have different chart of accounts. Different PMs report in a slightly different way, especially if you have PMs that use different software. And we work with a number of different PMs now because we're in different markets. So early conversation we have with property management companies is, you know, we'll share a sample report that we export from, you know, our Appfolio and our management company in New Hampshire, where, you know, we operate that. We say, this is what we want it to look like. This is the chart of accounts that we want. You know, this is how we want different things classified, and making sure your PMs classify capital expenses as capital expenses, repairs and maintenance as repairs and maintenance, and make sure all the accounting is right at the PM level. And last note, we run everything through our PMs. If we get a property tax bill, we send it to our PM. If we get an insurance bill, we don't pay anything out of our operating account. We want everything captured on our management reports because that makes end of year accounting a lot easier. So that's number one. Number two is we've built out a pretty well-developed asset management sheet in Google Sheets that we use. We use a lot of tech from an asset management standpoint to help stay on track and to help hold our PMs accountable. And basically our asset management sheet, what it does in a nutshell is, you know, right before we close, we upload our pro forma for the deal into the asset management sheet, years 1 through 5, which is typically how long we do our projections for. It has all of our projected, you know, rents, our projected expenses, our projected CapEx budget, and so projected rents in terms of these are the stabilized rents we want to achieve per unit, but also our projected gross income. So I should make that distinction as well. And then when we get our reports from PMs on a monthly basis, we go in and we have a virtual assistant in our business that does this, you know, amongst other things. They take that raw data from the property, they get it up into our asset management sheet, and then it's got some simple comparisons. How are you tracking from a collected income standpoint? How are you tracking from an expense standpoint? You know, actuals compared to projections. And then how are you doing on your CapEx budget? And are we achieving the rents that we wanted to achieve? You know, we achieved $1,095 for this one bed. What were our projections? $995. Great. You know, we're doing really well. Or if, you know, if we have a CapEx budget, you projected $20K to do this roof on this building, but you're at 22. All right, let's make sure we dial this in for the next one and have a conversation with our PM about this. So it's real time on a monthly basis, gives us like up-to-date reporting and accounting. And then it's just a matter of, you know, using that data to hold the right people accountable. So, you know, we have regularly scheduled calls with our management company for, you know, whether it's internal up in New Hampshire or our third-party companies down in Florida. And basically we run through delinquencies, vacancies, ongoing CapEx, and then any other topics, right? And then we also discuss that asset management sheet as well, which is a Google sheet that's linked to that calendar invite. Everybody has insight on a regular basis. So it's real-time accountability, and we have real-time data to discuss with our PM.
So you probably, it sounds as though you built that Google Doc yourself. You're not using any of these third-party cottage industry, syndication, asset management programs.
We're not. We built it internally, and there's probably an argument to use one of those tools or firms or companies to help with that. I don't think we're doing deals that are large enough to afford it yet. Most of our deals are 20 to 80 units in size. I think if we were exclusively doing 150 plus unit deals or something to where we just had more scale, that might make sense. But for what we're doing and the complexity of the business plans that we have, which are usually, moderate value adds, what we've built out is more than enough in terms of, getting the job done.
Okay. So once again, these podcast shows go by so fast. One quick question. What's the other market that you're involved in right now?
So we have a deal out in Indianapolis.
Okay.
We're not actively looking to buy more in Indy right now. I can get into why, we've kind of shied away from that. We had the thought of we want to be in the Northeast, want to be in the mid. Yeah.
Yeah. Indy is not a bad market. It's not a classy, a sexy market like Florida is. But it's not a bad market.
That's true. I don't think Indy's a bad market. I think it's a little bit, it doesn't necessarily align with the types of deals we like to do, I think is the reality. And I've also realized that, really dialing in your focus is pretty critical. So rather than trying to go deep and, spreading out slightly more shallow seeds across 3 markets, I'd rather go really deep in 2. And then, if we do introduce another market, it'll probably be again on the East Coast, maybe like a North or South Carolina or something like that. And the main primary reason is that I've been a little bit more mindful of this myself recently, is thinking about like, how are we being compensated for the time that we're investing in these deals, right? So let's say, hypothetically speaking, I'll create 2 scenarios. You go buy the 100-unit deal in Indianapolis with average rents that are $800 a unit. Or you can go buy a 50-unit deal in New Hampshire or Florida or North or South Carolina, somewhere on the East Coast, higher cost of living, where the average rents are $1,600 a unit. Like one of those deals takes less work, right? The 50-unit deal, after you close, the transaction takes the same amount of time to process. But once you close, your community only has 50 units. There's less to manage. There's just less of an operational drag on the business in terms of executing a business plan. So, but the income is all the same, right? The NOI is roughly the same. All of the financials are roughly the same. The property value is roughly the same. So for us, I think we would rather focus on those types of deals right now, especially because we typically look for these mid-sized opportunities, these 20 to 80 unit, opportunities. So we would rather just, buy deals with higher average rents. And we've also found that, the higher the rents, the more growth opportunity a market has, the easier it is for you to get bailed out. And when I say bailed out, that's an extreme term, but you go slightly over on your average renos. You projected 15 a unit, you ended up at 16.5, 17 a unit. But because there's bigger disparity between the rents you start at versus the rents you stabilize at, you're putting yourself in a better position for the market to help you out. Whereas out in the Midwest, if you're doing value add, which is what we do, very little margin for error, because the rents aren't growing fast enough to help you. So for that reason, we've decided to not focus on Indy. Not that Indy isn't a great market with good fundamentals, but for what we do, which is typically moderate value adds, if not heavy, we do a lot of heavy value adds. We'd rather be in an area where hey, we can get some more in rent when we're done. We can we're giving the market a better chance to help us.
Yeah, excellent, spot on. And my last question was going to be, what's next for you? But you kind of just answered it right there. So let me end with this one question: where do you find your investors?
Ooh, that's a good question. So I'm really active on social media, really active on Instagram. I also host a podcast. Would love to get you on there. Maybe we'll talk about that afterwards. And it's all multifamily. All I talk about is multifamily, similar to yourself. Yeah. And I've been doing it now for 2.5, 3 years. So once you get to that length of running a podcast or being active online, eventually good things start to happen. So for us, and I know you've been doing yours longer probably than that. So Podcast is a good source for us. I'm really active on Instagram. I have a bit of a following there. Post daily, and we get a lot of folks that just come through, join the email list. We nurture them, and eventually they see an offering of ours that they like and they participate. I'm getting much more active on LinkedIn now, and that's a good source for us. Okay. So really, it's all social for me. And I went that route because the personal network hasn't really hit an income level yet to start investing in deals from like a personal friends and family network.
You're gonna stop hanging around that New Hampshire crowd. So.
yeah, clearly. So for me, it was like, this is the way to get it off the ground. And now we're starting to get to the point to where a lot of referrals are what grows our base. So, we place a really, really significant emphasis on making it easy for our current investors to refer new ones, trying to do a great, monthly updates, quality updates, quality onboarding process. Obviously we want to meet what we say we're going to do from a deal standpoint. We've gone full cycle on a few and delivered great returns. So now we're starting to get some feedback from investors there. So really the top of the funnel is the social media. And then we try to really work the referrals from current investors.
Very cool. Very cool. All right, man. Hey, that was painless. I knew you.
That was great, man. I appreciate the invite.
Well, man, I apologize. I had to reschedule on you. I think I was sick as a dog. The name of his website is brickleafproperties.com. It's Axel Ragnarrson. And the name of his podcast is the Multifamily Wealth Podcast. So make sure you go check it out and do what you're supposed to do with mine, which smash the like button, subscriber, whatever you're supposed to do just to make it happen. I tell you, Axel, it's always the New Hampshire guys. We got it all figured out. You're a smart guy. I think you answered every single question correctly. I think you're going to do great. You're going to be the next Sam Tamposi and Jerry Nash.
Those are good names.
Yes, exactly. Yeah, very much so. So
it's got to be that cold air that hardens us. I think what it is. Also, I just want to mention too. So we actually rebranded recently. I might not have updated my bio in time, but best website is alignedrep.com, short for Aligned Real Estate Partners. So quick plug for everybody out there.
I thought it was Aligned RIP. I think, man, that doesn't sound like a good name. You shouldn't go rest in peace.
No.
Real estate
AlignedRep.com. Yeah.
Perfect. Good. All right. And I'll have Molly get in touch with you. I'd love to be on your show.
For sure. I'll set it up with her. I'll get her a link. Next time I'm up in New Hampshire, maybe I'll swing through Nashua. We got some buildings in Nashua.
You've been by my office a million times. Everybody knows exactly where my office is. So I'm behind the little red house between Holman Stadium and the cemetery. So
yep, I know that area.
Exactly. So,
I'm sure I've driven by it.
All right, Axel, good to meet you. We'll see you soon.
All right, sounds good. Thank you.
Take care, man.